for today. Hopefully you all can see the presentation over the next 50 minutes or so is laid out on the screen. And Josh and I will go back and forth, and I'll drive the bus and do my best to keep us on track with the slides. Best recession ever, obviously a little tongue in cheek. A lot of folks thought we'd get one last year. We didn't. The economy continued to expand. We had a great run for risk assets into year end. The end of the Fed's rate hiking cycle. The Fed meets today, and we're going to hear from Jay Powell soon. So what do we think about the world now that the Fed is done raising rates? Importantly, can stocks keep their momentum in the new year? It's a little bit of a red day today as opposed to green, but the S&P is still up over 2% year to date. Josh is going to dig deep into fixed income. Bonds had a good year last year, and what does fixed income look like again as the Fed goes from hiking to pausing to cutting? A few macro data points that we think are worth paying attention to, and then we'll end as always with what we like and what we don't like. There is a Q&A icon. Hopefully you all can see it at the bottom of your screen. Please type in your questions. We'll do our best to get to them if time allows. And again, if we don't, we will certainly follow up post webinar. So I'm going to take the first couple of sections, and then I'm going to throw it to Josh again as head of fixed income to really dig into the Fed, and we'll go back and forth. But obviously, Josh, as I go along, if I leave anything out, if you have anything to add, or if I just say something dumb, let me know, okay?
Sounds good. It's always a pleasure to be here with you, Tim.
All right, thanks, Josh. Okay, so the best recession ever. Right, so travel back in time about 13 months ago, a lot of folks thought 2023 was going to see a downturn in the U.S. economy. And these are just some headlines, some quotes from some really smart people, including Jamie Dimon, saying that the U.S. was due to tip into a recession in the new year. There's even a Bloomberg article. The headline was 100% chance of recession in 2023, and we didn't get it. We understand why folks thought a recession was coming. There were lots of data points flashing red as we entered the new year, including an inverted yield curve, which is the bond market based on the way yields were plotting out across bills, notes, and bonds. Implied a recession. That's laid out on the left-hand side of the screen. Whenever that blue line goes below zero, you have an inverted yield curve. Whenever you see a gray bar in this presentation, that's a period of recession. And usually when that blue line goes below zero, you get a recession. And on the right-hand side, the leading indicator index from the Conference Board plunged. And so there was good reason to think we were looking at a downturn. And then there were other serious headwinds last year, right? We had a regional banking crisis, March of last year. Manufacturing data, which we call out on the lower left-hand side of the screen, sunk below 50, and that indicates contraction. And the U.S. consumer, who has proven to be remarkably resilient. I never like to bet against the U.S. consumer. I never like to bet against the U.S. economy. Saw a meaningful spike in credit card balances, and that's an absolute number. So you always take absolute numbers with a grain of salt because balances are up, but the economy is bigger than it's ever been. But there were growing signs of consumer distress. But the economy managed to power through. We ended the year with an unemployment rate sub 4%, and which is plotted on the left-hand side. And we're going to get the January jobs data this Friday. It's a pretty busy week. The Fed meets. We get jobs data on Friday, but the unemployment rate's under 4%, and we added a couple 100,000 jobs per month as we move through 2022. So the resiliency of the U.S. economy is incredible. We printed a 5% GDP number in the third quarter. We got Q4 data not that long ago. The economy grew over 3% in the fourth quarter. And again, most of it comes back to the U.S. consumer. As long as the labor market's doing okay, the consumer should be okay, which means the economy should be okay. though there are signs that the labor market's weakening a little bit. And a big part of the last couple of years has been all the money that the government pushed out to the consumer during the worst of the pandemic. You saw a massive spike in the personal savings rate, well above what you see on the screen. And I think a lot of that money took a lot longer to be spent down than people thought it was going to take. And again, that just put a floor into the consumer, which continue to put a floor under the economy. So, as we know, our economy is about 30 trillion all in GDP. 70% of that is consumption. The U.S. consumer, what we do every day, the cups of coffee we buy and the cars that we rent. So again, my 2 cents has always been, you don't bet against the consumer most of the time. You don't bet against the U.S. economy most of the time. If labor is okay, the consumer should be okay. And that's really been the big story, I think, the last 12 to 18 months, that and inflation and the Fed. So if the jobs market is weakening, and there are signs it is, we may finally be past that inflection point in terms of the resiliency of the U.S. economy. But what a performance last year. So if you think about it, and I apologize for the typo, we're in 2024, but we're going to look at returns in 2023. This is just applied in the S&P 500. Again, and you think about the headwinds that the economy and the markets had to confront. And again, back to a regional banking crisis, SVB up on the screen stands for Silicon Valley Bank. We had First Republic go under, and Signature Bank as well. Those were the three largest bank failures in the history of the United States, except for Wachovia, if memory serves, which happened during the Great Financial Crisis. So, massive dislocation in the first quarter of last year. A picture of office towers. Commercial real estate has been under a lot of pressure, particularly in some cities that are struggling with elevated vacancy rates and quality of life issues. The Fed continued to raise rates through July. We got a downgrade to the United States credit rating, and you had the awful attack by Hamas on Israel. So I'm always just blown away by the resiliency of the markets and the economy. And I think all the things that have created that resiliency over so many decades, those factors remain in place as I think about the country and the footing we're on. So again, to sort of peel the onion a little bit on how we finished out the year, August, September, October were tough months for stocks and bonds. November was a fantastic month. So on the left-hand side, November 2023, the S&P was up almost 10%, one of the best months in the history of the index. And on the right-hand side, not to steal Josh's thunder, because he's going to dig into fixed income, November was the best month in the history of the aggregate. And I just said I wouldn't steal Josh's thunder, but I also think it's really interesting to point out, if you look further to the right, the worst months for the ag. I wish I had that little draw icon that Josh uses. I don't think I'm allowed to use that thing. Unfortunately, I haven't been given permission. But September 23, February 23, March 22, August 22, April, September of 22. So some of the worst months, most of the worst months in the history of fixed income, at least using the aggregate as a proxy, happened in the last 2 years. So it's been a tough run for stocks and bonds, but November was fantastic. Stocks were up about 10% for the quarter. On the left-hand side, we plot out the S&P, October, November, December. Stocks bottomed late October. And on the right-hand side, bonds were up about 6.5%, making up for losses earlier in the year. And this is what we got. We went into 2023, a lot of folks still on the back foot, considering how tough 2022 was. Lots of worries about a recession. Obviously, the geopolitical dynamic was already unsettled because of Russia, Ukraine, and then Hamas attacks Israel. And the S&P was up 26%, and good old-fashioned high-quality fixed income got us 6. Just an extraordinary showing. In terms of how we got there, going into year end, Again, August, September, October were tough months. The upside to tough months in risk assets is it tends to do a couple things. It resets sentiment, and people go from being optimistic to pessimistic, and that's a classic contrarian indicator, as we know, right? Warren Buffett often says, "Be fearful when others are greedy, and greedy when others are fearful." Hard to do, from a psychological and emotional perspective, but gosh, it's great advice. So, what we're plotting out here is bearish and bullish sentiment towards the market. And the blue line is optimism and the red line's pessimism. So if you can think back to the summer of last year, markets had an awesome run through July. And look at where bullish sentiment got, well above 50. And bearish sentiment fell all the way to 20. And then what happened? There were fears around inflation coming back in, and markets had a really rough August, September, and most of October. But then what happens is, as you get into October, bearish sentiment, that red line, spikes to almost 45%, bullish sentiment drops, and you've kind of set the stage for, from a contrarian perspective, for risk assets to bounce back. The other thing that a sell-off does is it makes stocks more attractively priced, all things being equal. Josh and I like to talk about how, not to be flip about it, our business is one of the few businesses where when things go on sale, a lot of folks don't want to buy them, right? If you've got a favorite jean jacket, I don't know if folks wear jean jackets anymore, and it's $100, and all of a sudden it's on sale for 50, you're probably going to buy it. If there's a great company and the stock is trading at 100 and then it's trading at 50, a lot of times people won't buy it just because of that price action. So corrections also help from a valuation perspective. So all we're doing is plotting out on the screen the price to earnings ratio for the S&P 500. And you see where it got, if you look at the 2022 number, it got down to about 14 times when markets bottomed in late 2022. You had a good run through the summer and then the pullback, and that reset valuation. So drawdowns are never fun. They can be very disconcerting, but the upside is they reset sentiment and valuation. Importantly, inflation continued to come in through the fall. On the left-hand side, we plot out the CPI and the PPI, the producer price index and the consumer price index. The producer price index hit almost 20%, and the CPI hit almost 9% during the worst of the inflation scare in 2022. So as long as inflation continues to come in, and it has, that makes people feel better about monetary policy, and importantly, in the direction of monetary policy going forward, and really importantly, earnings inflected higher. So we're still in Q4 earnings season right now, and so far results have been pretty darn good. But in October, we got Q3 earnings. Most companies are on a calendar year. And after 3 consecutive quarters of earnings dropping year on year, earnings inflected higher. So that's a pretty powerful combination, and something that we're keeping in mind as we go into 2024 and a presidential election and a very unsettled geopolitical backdrop. We could be looking at falling interest rates and growing earnings this year. And that's a pretty good combination historically for stocks. Okay, so end of the Fed's rate hiking cycle. I will turn it over to my colleague and my friend and our bond expert, Josh Flade. Josh, you take it away and let me know when to advance, and I'll do my best to drive the slides.
Awesome, sounds good. Yeah, I mean, looking at this chart on the left-hand side here, you can see what the Fed has done over the last couple of years. So we in 2022, we entered the most aggressive hike cycle that the Fed has had in the last 40 years. And you can see that in some of those numbers, right? The Fed was increasing interest rate by anywhere from 0.25%. And then there was a period of time where 4 meetings in a row, they increased it by 0.75%. Then going into 2023, the Fed continued to increase interest rates, but not at the same pace as the Fed was looking and seeing inflation starting to come back down. And now, as we already talked about, and Tim touched on this, we're seeing inflation come down. But all of this in context of what we've been through over the last 3 years makes a lot of sense, because we were in this high inflation environment in 2021, 2022. And what did the Fed do? Responded by increasing interest rates in order to try to tame inflation. And I think they've done a very good job of that, and we're seeing inflation come back down. So the question now is okay, the Fed's increased interest rates, they've paused. And so now the Fed is into the next phase of this cycle, which is to decrease interest rates or start to cut. And so it's not a question of whether the Fed will cut. The question is when and by how much. So let's go to the next slide. Looking at that chart on the left, that shows what the market thinks the Fed is going to do over this next year. So, and there's a disconnect between what the market thinks on the left-hand side and what the Fed is forecasting on the right-hand side. The right-hand side, those are the dot plots. Each dot represents an individual member of the Fed and their expectations where interest rates will be at the end of each of those years. So the market on the left-hand side is forecasting that we're going to see about 1.25%, if not a little bit more, of interest rates dropping, or the Fed cutting interest rates. But the Fed on the right-hand side is forecasting by the end of 2024 only about 0.75% of interest rate cuts. So there's a disconnect right now that we're seeing. We want to go to the next slide.
Yeah, and quick comment if I could.
Of course.
So the Fed obviously finishes its meeting today. We won't get an updated dot plot on the right-hand side, but Chairman Powell will have a press conference, and so folks in our business will be listening closely to see whether or not, to Josh's point, he kind of sticks to the script laid out in December, which is 3 interest rate cuts. We're not in a super hurry to do anything sooner than later, or because some of the economic data, not to get too short-term focused this week, has been a little punkish. Does he start to maybe move the narrative a little bit more to where the market is, as Josh articulated? So it's going to be an interesting afternoon, I think.
Yeah, the Fed has a difficult job, and there's a lot of data points they're looking at, trying to triangulate how best to move forward. Now, taking a step back and looking at previous Fed hike cycles, and once they come to an end, typically what happens going forward. And Tim and I are both students and very passionate about markets and history. And so we both really enjoy looking and seeing what has happened in the past and trying to triangulate, okay, well, if it's happened in the past this way, there's a chance that, history may not always repeat itself, but it definitely tends to rhyme. And so looking at that and looking at previous hike cycles and when they finished, looking at stocks, historically speaking, 6 months forward and 12 months forward on average are pretty positive. And we're seeing that play out here. If you look most recently, the last hike was in end of July 2023. The 6-month forward return was about 5.2%, a little bit below the average that we've seen. And then looking now forward for the next 6 months, historically speaking, there's only been a couple times where we've seen negative returns. And so broadly speaking, we think that markets are going to be positive. If we want to go to the next slide, looking at bonds, it's a very similar story. In fact, this is an even better story than equities. There's no negative returns over 6 months, and there's no negative returns over 12 months. And so this points to the fact that as interest rates are coming down, you're likely to see interest rates come down across the curve, and you're going to see pretty good performance, especially really good performance on a risk-adjusted basis for bonds. So we're especially bullish on bonds and making sure that your portfolio is adequately diversified across both equities and bonds, because we think forward returns on bonds look pretty positive. I love this quote. This is from Dr. Friedman, a very famous economist. The central empirical finding in dispute is my conclusion that monetary action affect economic conditions only after a lag that is both long and variable. So that's the question that the Fed is asking themselves right now. So they have increased interest rates, which is that monetary action, and now they're looking at the effect on the economy, and that effect can be long and variable. So it just depends. And so that's what they're watching, and that's what they're looking at. So if we want to go to the next slide, a couple data points that we're looking at, because although the market, and we'll talk about this, is pricing in kind of this no landing scenario, or maybe a very soft landing scenario, there is data underlying in the markets that's a little bit negative, right? So we're starting to see that on the left-hand side, credit card lender charge-offs. So that's tied to just credit card delinquencies. And so we're seeing delinquencies in credit cards come up, And so what are banks doing? They're starting to make charge-offs in preparation for those delinquencies. And so that's what that chart is showing. So it just that chart is showing, and it's just showing that there is some weakness. And then the same thing on the right-hand side, that's the job openings. Both of these, you can see the job openings are going down and to the right. And so both of this point to kind of a little bit more of a softening in the economy, which is exactly what the Fed is trying to orchestrate right now. So the economy was a little bit too hot. They're trying to kind of let the economy cool down, but not cool down, hopefully, into a recession.
Yeah, and it's an overused analogy, and maybe it doesn't even sort of line up because you're talking about interest rates in a tanker. But people talk about sort of a speedboat and a tanker, a big tanker or cargo ship. It takes a long time to turn something like that, and monetary policy is very similar in that you cut, or you raise, and raise in terms of rates, and it takes a while for all that to impact the economy. And so to Josh's point, the Fed's watching all this because they are going to cut, but they don't want to cut too soon. But if they wait too long, the impact of those cuts will be felt too late to avoid a recession. That's a possibility. So it's again, it's maybe it's an overused analogy, but it's hard to get the lag around monetary policy can be so long that if you wait just a little bit too long, you missed it. And the Fed obviously doesn't want to put the U.S. economy into recession.
Absolutely. Yeah. The way I like to say it, and that's a great analogy, is the Federal Reserve's policy, monetary policy, is a very blunt instrument, right? It's not a scalpel. It's a pretty blunt instrument. And so it's hard to know exactly what's going to happen and how long is it going to take.
Yeah.
This is a great slide because I think it points out kind of the potential path going forward. And then also when we think about these different paths, what's potentially priced into the market, right? So a few different paths: a soft landing for the economy, or a mild recession, or potentially a hard landing, or even in a kind of a best case scenario, an acceleration in economic activity. And so those are the different potential outcomes that are there for the economy. And what the market's trying to do is price in what is the most likely outcome. And so as we look at it, and I kind of think that the market's pricing in kind of more along the lines of somewhere between kind of that soft landing, maybe a very mild recession, to kind of that acceleration in the economy. It's pretty obvious the market's not pricing in a hard landing. And if it is pricing in a little bit of a mild recession, it's pricing in an extremely mild recession, I'd say. I don't know if Tim, what your thoughts are on that.
Yeah, no, I agree. I think and Wall Street and Main Street are linked, but they're different, they're distinct. And so I think that, to your point, the market's pricing in, which I think another way of saying is like, what would the market be okay with, kind of, for lack of a technical term, some sort of soft landing, sideways, a couple sideways prints for GDP maybe, or mild recession, because that would allow the Fed to cut. That should pull yields down. Corporate profits might be bumpy, but the markets would be okay. I don't think that hard landing is priced in, because that would mean a drop in profits that I think no one is expecting. The acceleration in economic activity, I think folks are coming around to the fact that we may not get a recession, and I thought we'd be in a weaker state than we are right now. An acceleration would be okay, and I hate to root against the economy. I think an acceleration in economic activity that also saw inflation pressure also spike higher would, while good for Main Street, I think Wall Street would be a little worried that the Fed has got to hike some more. So I think a soft landing, mild recession's priced in. A decent economic environment with still subsiding inflation, which is a little bit better than maybe a soft landing. I think all that would be okay. A hard landing and a spike in inflation, I think, would worry stock and bond investors for sure.
Yeah, it's kind of funny. It's kind of like with that acceleration and a scenario where you see inflation start coming back up again, it's almost like too much of a good thing is a bad thing for the markets,
Yeah.
right? In that sense.
Yeah. Okay. So can stocks keep their momentum in 2024? We're about to say goodbye to January. Last time I looked, the S&P was up a little over 2%. Growth stocks are doing even a bit better. Small caps are struggling a little bit here year to date, but 1 month is not a year make. Some of these slides we've used in our most recent call, and we think they're are worth revisiting. So at a high level, we think if we're not looking at a hard landing, and we don't think we are, or a big spike in inflation, and we don't think we are, we think risk assets can do okay this year, even if the real economy struggles a little bit because of the effects of all those interest rate increases. So, I'm a big fan of looking at market history to try and put current events in perspective. We've shared this slide before. It's a bit busy, but the blue stretches on the screen represent trough to peak moves in the S&P 500 going back about 70 years. And the burgundy brown stretches represent peak to trough moves over that same time period. So, I know I'm telling us stuff we know, but markets go up more than they go down. And that's because the economy expands more than it contracts. And even with all of our problems as a country, the underpinnings, I think, of the economic miracle that we all participate in are still in place, which means, the economy should grow more than it shrinks. And if you go back even further to the late 20s, bull markets last 2.5 years or so, give or take. We're only about 7 months into the current bull market, which got going in June of last year. So if history is any guide, it's early days, right? Now, obviously, history can't be looked at on a standalone basis. You have to look at profits and interest rates and the health of the private sector and all that. But, it's a pretty interesting data point, we think. FOMO is, one of the more popular acronyms in our business, fear of missing out. So what's interesting is we've got more money in money market funds than at any point in the history of money market funds. And we plot that out on the screen. Now, again, the economy is bigger than it's ever been. So I always like to put things in perspective because I think, looking at data points on a standalone basis can be a little misleading. So the economy is bigger than it's ever been. We've got more money in money market funds than ever. By one account, because this print was as of several months ago, it was north of 6 trillion. Some people think it's closer to 8 trillion. And some of that money is in there because money market funds offer much more attractive yields today than they have in a long time because of the Fed raising rates. And I think some of that money's in there probably because folks ran away from the traditional banking system a year ago when Silicon Valley Bank and folks like that were struggling before going away. So it is worth pointing out, though, that 6 to 8 trillion is a lot of money that could come out of money market funds and into stocks and bonds, especially, and this is an important point, we think, as the Fed cuts rates and the yields on offer from those funds become much less attractive. So the proverbial dry powder is there. The other thing that's encouraging about the market since October is as impressive and as compelling as the Magnificent Seven have been from a return perspective, right? The Alphabets, the old Google, Meta, the old Facebook, Apple. We plot this out on the right-hand side of the screen. Small cap stocks, as measured by the Russell 2000, which is the benchmark for US small cap equities, are up 20% plus since late October. And as we look at the market, and Josh and I and the team look under the hood, it speaks to kind of a broadening out of the rally. It's not just half a dozen stocks doing all the heavy lifting. It speaks to growing investor confidence in the bull market, again, which is about 6 or 7 months old, and if history is any guide, could run for another 2-3 years. As earnings growth picks up, we're looking at the earnings yield relative to the 10-year Treasury yield. Because ultimately we live in a relative world. What's attractive? Stocks, bonds. What's more attractive? Stocks or bonds? And to Josh's point, bonds look pretty darn good to us, and stocks look pretty good as well. So you can and should have exposure to both. But as earnings pick up, because you've seen this massive spike in yields making fixed income attractive, stocks look a little less attractive. But as earnings growth accelerates, all of a sudden that earnings yield moves higher, which makes equities also attractive on a relative and an absolute basis. This is a very busy graph. Lots of colors, lots of lines. It's just looking at PE ratios for the more important sectors within the S&P 500. And you've got a couple that are expensive relative to history, including technology and consumer discretionary, though technology tends to trade at a high multiple. You look at the PE numbers on the left and then go to the right. But lots of the market, big chunks of the market trade sub 20 times earnings, which isn't necessarily dirt cheap, but is more compelling. And valuation becomes more supportive, even at those more elevated multiples, as the Fed starts to cut rates, which they should be doing this year. So it's early days. We've got a presidential election. We've got a very unsettled geopolitical backdrop. We're going through earnings season. But for us, the big takeaway is we are in a new bull market. There's a tremendous amount of cash on the sidelines. And if history is any guide in fits and starts, stocks should be biased higher this year and theoretically, in theory, beyond this year. So I will stop and I'll turn it over.
Hey, Tim.
Yeah,
Tim.
please.
Hey,
Kurt.
so, yeah. Hey, sorry. I know I've been quiet. Yeah, uncharacteristically quiet. Sorry.
Yeah, I know.
One thing you touched on it a minute ago, but I think is super important is historically, when you talk about this cash that's on the sidelines, it's not just the fact that the cash sits there. It's that there's so many different sentiment surveys show how pessimistic the investment community still is.
Yeah.
Which is so interesting because the last couple of cycles, we've kind of seen this behavior. Like in the old days, it was like if stocks went up, everybody felt good and everybody felt bullish. And we're not seeing that. And it's just not normal to have an economy doing as relatively well as ours is, to have the prospect of lower rates and so much cash on the sidelines, and yet have people feel so pessimistic. University of Michigan looks that way. I mean, there's a lot of different survey work that looks that way. What's interesting about that is that is historically when you want to be investing. And I know it's really hard for us to get our minds around it, but we're talking about several quarters in a row now of people being surprised that things are as good as they are. And that's what gives this this market the possibility of really extending gains for a long time. Because there's so much liquidity in the system and people have been so pessimistic. Our high net worth clients are sitting on really like an uncharacteristic amount of cash. And that's just, or really short-term treasuries. And that's just not going to sustain. So that money needs to come into the economy, and it will at some point,
Yeah, no, that's a great point. And to maybe try and sort of square that circle, people are pessimistic, because we've just lived through the first meaningful inflation cycle in 40 years, right? And so we had to deal with that. And I think the reason, not to get into politics, the administration polls so poorly on the economy is even if inflation has moderated, prices are still a lot higher than they were, right? 3-4 years ago, and people still see that at the grocery store. So you do have this kind of weird dynamic where markets are doing well, the economic data looks pretty good, there's all this cash on the sidelines, and a level of pessimism that doesn't really make sense, not to be judgmental of anyone, and to your point, is additional fuel for that bull market fire. And my guess is it's that inflation hangover that really none of us have had to deal with in 4 decades. And that probably does, makes it allows this cycle in a good way to play out even longer for investors.
Absolutely.
Yeah, great point. Okay, Josh, let's go back to you. And how about bonds?
Great, sounds good. And to Kurt brought up a really good point where I think people feel good and safe with having their money in a money market account and where it's invested largely in treasuries and they're getting 5.5%. But that's going to change quickly when the Fed does start decreasing interest rates and you fast forward 12, 18 months and suddenly those people are getting, who knows, right? 3%. That's not going to feel as good as 5.5%. And that money, they're going to start putting that money into other things.
Yep.
Looking at the performance this last year, pretty good performance first half of the year, and then with a little bit of choppiness around interest rate expectations. So we're looking at a broad right here, the Bloomberg Ag, which is kind of a broad basket of bonds, largely kind of treasuries and mortgage-backed securities. And then as as expectations around interest rates changed towards the latter part of the year, suddenly you saw a big sell-off as investors and as Wall Street kind of expected the interest rates may stay higher for longer. And then that sentiment completely changed in the last couple of months of the year. So you saw a really, really strong rally across all types of bonds in the last 2 months. And therefore you saw fixed income perform pretty well last year, ending on a high note. If we want to go to the next slide, putting last year's performance in context. So, this is treasury bonds. So treasury bonds were up 5.5%, but this is coming off of two of the worst years in a row for treasuries in the last almost 100 years. Looking at this chart, the majority of years are positive for treasuries, for 10-year treasuries, but we saw two of the worst years in a row in the last 100 years. So it was a relief to see some positive returns last year. And our expectation is that rally in bonds is going to continue into the future. So if we want to go to the next slide.
Yeah, I stole your thunder on this one.
Yeah, you stole my thunder. Putting November in context, I mean, just an unbelievable month. I think this data goes back 30 years. And so the last 30 years, the best single month of performance in the Bloomberg Ag we experienced in November. So it's pretty powerful month for fixed income.
Yeah, and again, maybe Kurt will let me use the annotate pen at some point, but again, on the right-hand side, it's remarkable to me that September 23, February 23, March, August 2022. I mean, it just the pain fixed income investors had experiences. The Fed dealt with, inflation at a 4-decade high was just so meaningful. And again, to Josh's point, speaks to the opportunities now that we're on the other side of this. That on a go forward basis. So it's just pretty remarkable return stream.
Yeah, no, you bring up a good point. And I always talk about this. The bad news is that, obviously we had a couple of years of underperformance. The good news is interest rates are higher. Now it's a fantastic time to allocate to bonds. Yep. We talked about this a little bit before around the yield curve beginning to normalize. So I just say, the positive here is that if we see this yield curve normalization, meaning that interest rates farther out the curve are higher than interest rates in the short end of the curve, and we can avoid a recession, that's going to be very positive for the economy.
Yep.
This slide I like because of the fact that it kind of paints, okay, what kind of yields can I get for the risk I'm willing to take? And so you can see they're going from high yield bonds on the left-hand side, 8% yield all the way to 30-year treasuries at just north of 4%. But overall, I think the most important thing here is that there are real opportunities here for good returns going forward, and you don't have to take significant risk. I want to point out that kind of A-rated corporate bond. You can buy A-rated corporate bonds and get a 5% expected return. And this is yield to maturity. And historically speaking, yield to maturity is a fantastic indication of your expected returns going forward over the next kind of 5-10 year period of time. And so that you can buy A-rated corporate bonds, really strong companies, good balance sheets, good cash flows, and get north of 5% yield. That's a very good risk adjusted return. And we haven't seen that in 15 years. And so this is a fantastic environment to be able to invest and get pretty attractive returns without taking much risk.
Yep.
This slide's talking about just the hedging costs, and I think the thing that we just point out here is just hedging costs remain relatively low historically speaking, and what this kind of implies, or what the market's kind of telling us, is that the market's not expecting significant volatility going forward. So I think it's just an indication that market expectations are relatively benign, which I think would be good for fixed income and bonds going forward.
Yeah, and for the economy too, right? As important as the equity market is to the world, I'd argue, even though I'm not a fixed income expert like Josh, that the fixed income market's even more important, just the size of it, and how often companies come to the fixed income market to raise capital, and you do tend to see the fixed income market sort of dislocate ahead of a meaningful contraction in the economy, and so that sort of more benign backdrop probably also speaks well of where the economy should be going. And I think we already touched on this one a little bit more. Sorry, a little bit earlier, Jess, but why don't you go ahead? Sorry.
Yeah, and I think the key here is just forward expectations on interest rates. The expectation interest rates are going to go down, and all things being equal, if interest rates are going down, bond prices are going up, and that means returns are going to be positive. And then you add on to that the coupon payments you're receiving on your bonds, and you can I can easily see an environment over the next 12 months where you could get mid to high single digit returns in very low risk bonds in that scenario.
Yep. Okay, a few things we're thinking about. Again, more macro, and I'll spend a couple minutes on this. We're about 45 minutes in. China's been in the news. Well, China's always in the news, the world's second largest economy, and our primary, most would, I think, argue sort of geopolitical opponent for influence, economic and military and geopolitical influence. China's been in the news sort of for all the wrong reasons from an economic perspective. Their stock market is down about 7% year to date, about 29% year over year, had a terrible 2023. We plot out the Shanghai Composite over the last couple of years on the left-hand side, and it's really well below where it was 3 years ago. And on the right-hand side, much of the Chinese economic miracle, for those that want to sort of use that term, over the last 30 years or so, has been real estate property sector driven. And you're just seeing a dramatic contraction in property prices and also planned investments in the real estate space. So, the U.S.-China dynamic, we'd argue, has changed a lot in the last 4 or 5 years or so. We've always been competitors, but it's taken on I think a much sharper edge, again, from a geopolitical perspective under Xi Jinping, the president, who's now president for an unprecedented third term. Their economy had been doing really well for a very long period of time, up until COVID. They locked down the country and they finally reopened, and it's proven to be a very disappointing economic performance post reopening. So, there are a couple things ailing China, including tough equity markets and the property sector, that it's not working. On the left-hand side, that manufacturing data that we talked about earlier for the U.S., we also get it for China. Their PMI, after a short spike when they reopened the economy coming out of COVID, has been sub 50, which speaks to contraction. And on the right-hand side, their version of the Federal Reserve, their balance sheet continues to swell as policymakers try and put a floor under the economy and risk assets. And there was more news out late last week, this week, that their central bank, the People's Bank of China, and the central government would pump additional monies into the economy and in the market to try and put a floor under both and improve sentiment. But so far, it's really not working. So again, the world's second largest economy, a very important market, one we're paying attention to, but one that's been struggling and one that we've been meaningfully underexposed to for some time. And we think that's the right position to take. We obviously have the very difficult geopolitical backdrop: Russia, Ukraine, Hamas attacking Israel. We wanted to remind everyone that the U.S. is an energy superpower. We are producing more crude oil than we've ever produced. We're the world's largest producer of crude, and we just plot out the millions of barrels a day produced by the U.S. on the screen. You go back to 2009, it was 5 million barrels a day. As hydraulic fracturing really kicked in, it's north of 13 million today. And so we mentioned this in the context of the geopolitical dynamic, especially considering what's going on in the Middle East, with West Texas trading below $80 a barrel. And I can't imagine where the price of oil might be if we still had the same energy profile we had 20 years ago, and we were looking at the world we're looking at today. And our energy profile, our ability to produce so much oil and so much natural gas, which we plot out on the screen, has changed, I think, our vulnerability to geopolitical shocks, has been a tremendous national security and economic development for our country, and really is a game changer, especially considering for our economy, especially considering what the world is dealing with right now. And this is a point we've made for a while, not to be hard-hearted about the geopolitical dynamic, but markets do tend to look past geopolitical events. So you look at the S&P on the left-hand side of the screen. Hamas attacks Israel. We're well above those price levels now, and oil, as I just mentioned, on the right-hand side is below where it was in October. And again, our energy profile is a big part of that. And then finally, we've got a presidential election coming up. It looks like it will be a rematch between President Trump and President Biden. Markets tend to go up in the fourth year of a presidential term or in the presidential election year, but they tend to stumble, interestingly enough, early on in the year, really through March and April. So that's something we'll be paying attention to in terms of price performance. At the risk of stating the super obvious, markets go up over time, regardless of who holds the White House. And we're just plotting out the S&P going back to President Kennedy in 1960, blue for Democrat, red for Republican. Recessions happen under both parties, and bull and bear markets happen under both parties. But we do think, that said, that while markets go up regardless of who holds the White House, a contentious Congress is best. And we think we're going to get that. On the left-hand side, you see what the S&P has done with a divided Congress and a Republican president, and then a divided Congress and a Democratic president. And that's north of 13.5%. And the idea behind a contentious Congress or gridlock or divided government is that markets don't like surprises. And if you have gridlock, the odds of big policy changes being enacted, catching the economy and the markets off guard, are very low indeed. So we think we'll get that. Regardless of who holds the White House, our best guess is the other end of Pennsylvania Avenue will be a divided Congress. And again, historically, gridlock is good. So I'll stop there. I'll turn it back over to Kurt to lay out at a high level what we like and what we don't like, and to close out the webinar. Kurt?
Tim, did you just have a slide titled "Contentious Congress"? That seems redundant to me in some way. I don't know.
Well,
I haven't heard that before, but I like that. I like that.
I will sometimes bend over backwards to pull off alliteration, and sometimes I probably shouldn't do it.
I love it. Because isn't that the truth?
It is for sure.
Okay, so let's bring all this home then, wrap it up here. So the checklist in terms of how our investment committee feels about scorecarding what's going on, inflation coming down, Fed almost for sure cutting rates, could start soon. Bull market underway, probably has some legs, right? Valuations are reasonable. We talked for a minute about earnings coming in. Earnings are surpassing expectations, so that would make valuations go even lower. As you come around the turn from rate hikes, that has a tendency to be a tailwind. We talked about sentiment. I don't ever really get super nervous about investment assets until everybody's loving them. We're nowhere near that. Substantial cash, we talked about that. There's a ton of it. Markets, we had priced in this recession. I think the market's kind of been acting so good because maybe that's coming off a little bit. So it's debatable, how much is priced in. Labor market, of course, in fantastic condition and improving. People actually wanting to come back to work, go figure. Post-COVID, nobody's paying them to stay home. Consumer has been resilient. Again, it's sort of the tale of two cities, because you've got that lower third of the represented economy that has struggled. They are using credit cards and things like that. But you've got the other 2/3 that have been, really in pretty good condition. We talked about bonds being back, what that means, the ability to make a return on cash, which for many years we just didn't have that luxury. That's good for everybody in the economy, right? Then, of course, a strong dollar. We always talk about the U.S. being the best house in a bad neighborhood. The things we don't like, of course, some of the geopolitical stuff we've been talking about. You never know. You can't build a portfolio around that. It's impossible to game this stuff. If you've been waiting for China to invade Taiwan, you've been waiting for 20 years to make an investment, right? So you can't game around this stuff. DC is a total mess, continues to get worse. honestly, like, and I think we're all in this position. I mean, a lot of days I get up nervous right now. We're headed for a civil war, right? I mean, but again, cooler heads typically prevail because at the end of the day, we're all working off the same pocketbook. We know what ultimately affects the economy, what makes things work and not work. So, every time we face one of these situations in this country, we have a tendency to ultimately make the right decisions, but you never know. So that's definitely a risk sitting out there, especially in a heated year like we're going to be having coming up towards the fall. Hard landing, definitely not priced in. Another thing not priced in is a sudden re-ramp of inflation. Probably not going to see that, but that is definitively not priced in. We're firmly in the camp that we've got the inflation under control, at least for now, for this cycle. We've got to get some more, market leadership. We've talked about this. Small caps, emerging markets, and things like that are probably going to have to start participating. And they typically do. And that's probably good news because they have a tendency to lead a little later as people get more confidence in what's going on. They're not hiding anymore just in the big blue chip, safe mega cap names and whatnot. Commercial real estate, we're always worried about this. This is one of those possible flies in the ointment. It's a little bit challenging to handicap how bad the debt books look as it relates to different tranches of commercial real estate. And not all commercial real estate is created equal, right? We've talked about this in prior calls. The other thing we have going for us is, things that are this well telegraphed are not typically the things that tip an economy over. It's usually the stuff you don't see coming. And we've seen this coming for a long time. And a lot of banks and hedge funds and insurance companies have written down their commercial real estate portfolio. So a lot of the pain has actually, from an accounting standpoint, has already been realized. But again, there are bodies buried out there, and it's hard to know exactly where those are. And we also aren't looking for, necessarily really high U.S. growth either, which starts to matter. And so as we're running large deficits annually, right, you're starting to pay more. The government is to issue bonds, right? So we're going to, you can't just grow your way out of it. So we're going to have to do some work there. So Tim, that's kind of our scorecard, and man, it's an interesting time, and going into the fall is going to be very, it's going to be a little wild.
It's going to be a little wild for sure. No, that's all great stuff as always. So we had a couple questions. We've got a few minutes left, so I'm gonna do my best to because they're linked. I think it's around the dollar and the debt. So I'm gonna throw these both out to you, Kurt and Josh, and I'll weigh in. First is, and you already talked about the U.S. being the best house in a bad neighborhood. Though I prefer your other analogy, the cleanest, dirtiest shirt in the hamper, maybe, Kurt. I always like that one. Hopefully I didn't butcher it. So any thoughts on the dollar? Some folks predicting a decline. It's off its 2-decade highs, but still pretty elevated. And then any concerns around the debt and deficit? DC, to your point about a contentious Congress and a dysfunctional DC, we're still working off of an interim sort of spending deal. The Congress still got to deal with that, along with Ukraine's out there and Israel aid and the border. So Kurt, why don't you go first? Any thoughts around the dollar and debt deficits? And Josh, you weigh in as well, and then I can kind of wrap things up.
Yeah, for what it's worth, on the dollar discussion, this is like gold, right? It's always it's a really heated debate in the wrong room. But my own personal view on it is this: when you talk about currencies globally, it's important to remember that everything is relative. It's not nominal, because what happens is we all have to park assets somewhere. So this is like the bear chasing the family in the woods, right? I just have to be faster than you, right? So what's happening is, with all of the difficulties that we have at home, and I am really not a fan of what happens in Washington. Like, it's really a clown show. But in relation to the rest of the world, there just isn't another place to put your assets. There's just not. Crypto is not even a viable discussion. It's, nobody wants their money in China. This is exactly the problem. China might have the second largest economy in the world, but the reason it is languishing so bad is the world doesn't trust them. And at the end of the day, currency and debt is exclusively about trust. And so where do you park your assets? Do you park them in the euro? I mean, that's laughable, right? Do you park them in Japan? There's nothing there. You can't park them in Asia. So what happens is every time the world gets stressed, they run to the dollar. So as bad as we tend to govern ourselves here, still in relation to the rest of the world, it's dramatically safer to have assets in the United States. And that, that's not an excuse for what we're doing, but it's sort of a reality. And when you talk to big asset allocators, there's just no discussion of actually turning away from treasuries of the dollar. So I don't know if that's helpful, Tim, but that
I
one
think
man's answer.
No, we live in a relative world for sure. And your point about not trusting China is huge. And the U.S., again, for all of its shortcomings, is a rules-based economy and system, and we treat capital fairly, and there's transparency and liquidity, and that's not going away anytime soon. Josh, any thoughts on the debt and deficits on an absolute or relative basis, and whatever risk those two linked points might present for the markets or the economy?
Yeah, no, I mean, last year there was a lot of expectation around weakening or softening of the US dollar, and it played out a little bit, not as much as people expected. I think interest rates obviously a big driver, right? Kurt was talking about everything is relative. So yes, like if interest rates come down significantly in the US, but they stay higher in the the EU or these other countries, yeah, you might see a little bit of softening in the US dollar. So in those scenarios, somebody asked about, what could I invest in? If you are a firm believer that the dollar is going to soften significantly, international exposure could make sense for you. But as far as the US government, and I agree with Kurt, it's a bit of a joke, but at the end of the day, I think that there is a path forward for us to get the situation in control, I think to some degree. And so I think, like, I'm still cautiously optimistic. And I think that if you look at Japan as an example of a country that has significantly more debt than their GDP, they're also, it's not unheard of for countries to have a lot of debt and for life to go on, right? Like, people still have children, they still have their families, they still go to work. Like, there is a path forward. And I think that we can continue to kind of inflate our way out of this significant debt that we've built up. And the reality is interest rates are going to come back down. Borrowing costs for the US government is going to come down. We might see a scenario where you might see taxes going up to help cover some of that. And I think everybody, if they look themselves in the mirror and ask themselves, well, in 10 years, do I think taxes are going to be lower or higher? I think the answer is, I think taxes are going to be higher. And so there are levers to pull to get the situation a little bit better under control.
Yeah, no, those are all great points. And not that anyone in DC would ever tell you they're rooting for a mild recession, especially when it's an election year, and not that we're rooting for a recession. But to Josh's point, a recession would mean Fed interest rate cuts, lower bond yields, lower borrowing costs, and that would be a meaningful positive for the government in terms of its ability to finance its day-to-day operations. So we're a couple minutes over. Just wanted to thank everyone for their time today, for hopping on the webinar. We hope you found the content of value. We'll be with you all again in 90 days, in 3 months' time. Obviously, if there's anything you need in between, any questions or comments, anything we can help you with, please reach out to us. Kurt and Josh, it's always great being with you both. And thank you all again for joining the webinar. Take care and just have a wonderful day.
Thanks, Tim.